evening and welcome to The Money Show. I'm Nantara Rai. The Money Show is the only show of its kind in all over India. Every weekday we come to you at 5:30 p.m. with a new financial expert in our studio to answer all of your financial queries with just one aim in mind: how you can save your money the best way, how you can grow your money, what works the best for you. Just a quick alert before I carry on. It's Wednesday, so it's our tax special on The Money Show over the next 30 minutes. That means till 6 p.m. you can call us and get your queries answered live right here on The Money Show. The numbers on your screen. You can also send us an email. We have a Facebook page. You can also tweet us. We'll be taking all of your queries. Now, I told you it's a tax special. 31st March deadline looming large to file your tax returns. Protect your hard-earned wealth from the tax acts and invest in the right and best way. We're not telling you to avoid taxes. We're just telling you to be tax efficient. And our expert today is Hemant Rustagi of Wiseinvest Advisors. Hemant, you know, it's always a pleasure having you on The Money Show. Let's just begin with talking about the income tax return forms and with the process that one needs to follow. What is the one thing, the checklist that you advise before filing these returns?
Well, I think it's absolutely important that before you file your return, make sure that all types of income, whether it's capital gain, your salary income, or whatever income you have, everything has to be shown in the income tax return, even if it's a tax-free exemption, whatever. All that information has to be provided. I think it's very important also to go to income tax portal, and there's a form called 26AS. So what you can do is there you can see all your tax credit and every information is available there. So before you file the return, make sure that every bit of information that you're putting in is matching with that, so that you don't face any problem in processing of your income tax return.
I'm going to come back to you for more details of that checklist and what that one needs to keep in mind. But, for our viewers, there are lots of schemes that are out there legally and being advised by the government for all of you to become tax efficient. We're going to decode, one of the most famous ones, the Public Provident Fund, the PPFs as they're called. Should you go in for a PPF? What you should go into looking for a PPF? Are there better alternatives? We're going to talk about all of that here on The Money Show. But here's first up a quick report by Mubina Kapasi. And she's going to teach you how to save 46,800 rupees by investing in PPFs.
With the last few days left before investors and assessees can make their investments with respect to saving taxes, and we at ET Now are going to get you a list of all the options, starting off with the basic and of course the immensely popular Public Provident Fund, or what's more commonly known as PPF. You can make this investment by a minimum contribution of just 500 rupees, but only up to 1.5 lakh rupees is the kind of deduction you can claim from your total income. So interest rate, very attractive again, 8% is what's currently fixed at, and mind you, it's compounding, which means you will be earning interest on your interest as well. Additionally, what's important to note is the fact that while you get the entire deduction of up to 1.5 lakh rupees, that brings you to a cumulative saving figure when it comes to taxation of 46,800. Let's exactly decode what exactly would you be gaining. A simple 1.5 lakh rupee investment per year, if you make that investment for 15 years every year, it could get you 44 lakh rupees on maturity. Now, what are the benefits? Well, firstly, when you make the investment, you get a deduction from your income. When you earn the interest, it's tax exempt. And even when you withdraw from your PPF, that as well is tax exempt. Which brings me to my next topic, withdrawal. Well, that's where the bigger of hiccup arises, because you can't exactly withdraw from your PPF. You can just make a partial withdrawal after 5 years, and after 15 years only is when you can essentially withdraw the entire amount. Who can open a PPF account? Well, almost everybody, as long as you're a resident in India. So key things to note, well, firstly, you can head over to any of your banks, SBI, ICICI Bank, Axis Bank, HDFC Bank, PNB. All of these banks do have a provision for you to open a PPF account. documents to require? Well, take note, you will need address proof, you will need ID proof. So an Aadhaar would do, an electricity bill as well would work, a passport would work, and 2 passport size photographs. Ensure you do carry these as well. Of course, do remember that there are certain drawbacks as well to a PPF, and that is firstly the restrictions when it comes to withdrawals, the fact that you must invest every year to avoid inactivation, and thirdly, don't expect higher returns. That could come more from equity-linked saving schemes. But yeah, this certainly is a safe bet, especially if you want to save up for retirement.
Okay, so that's what you need to know about PPFs, or the Public Provident Fund, and how you can save up to 46,800 rupees. You have a second option as well, by the way. You can invest in the equity-linked savings scheme that is also allowed under Section 80C of the Income Tax Act, and it has the shortest lock-in period. It's the shortest lock-in period of about 3 years. Now, what works? What are the pros of an equity-linked savings scheme? Again, like the PPF, you can save up to 46,800 rupees under Section 80C of the Income Tax Act. The funds have so far given inflation plus returns in the long term, and they have outdone what you would have earned with a fixed deposit for sure. They also have a better trend than PPFs. 2 times better returns is what an equity-linked savings scheme can give you. And the best part, you can buy an SIP for as little as 500 rupees. So, let me go back to my expert of the day, Hemant Rustagi. Hemant, do you have a personal preference, PPF and ELSS? What is it that you advise your clients, and why?
Well, I think both are very, very important, I would say, options to save taxes. Clearly, we're talking about completely different option, 2 different asset classes. PPF, I would put it in the debt category, and ELSS, as the name suggests, is an equity-linked savings scheme. So basically, you're investing in an asset class called equity. But if you look at in terms of potential, if you look at PPF, clearly you know that your money is safe. You know that you're getting tax-free return. So and which is kind of fixed every quarter. So currently, which is 8%. So if you're someone who's looking at investing in an option where you don't want to take a risk, PPF is a good option. But the other option, when you talk about equity-linked savings scheme, as I mentioned, it invests in equities. Now, these are essentially, even though they have a lock-in period of 3 years, but it doesn't mean that you have to take out money after 3 years. You can keep it for longer term. You can actually align it to your long-term goal, like children education or your own retirement plan. In terms of potential, even though equity market by nature tends to be volatile from time to time, so if you take SIP route of investing in ELSS, you can kind of control that volatility to a large extent. In terms of potential of return, you can get much higher return. When you give 15-year period to PPF, you give a similar period to an equity investment, especially when you're looking at ELSS. It doesn't mean that it has to be in the same ELSS. After 3 years, you can actually move that money into a normal fund. In terms of potential, I think you can actually get much, much higher return. Now, the option whether you should go for PPF and ELSS will clearly depend on 2 things. One, what we've generally seen is most investors in India have a lot of money invested in bank deposit, PPF, or EPF. So there are other different options where it's very, very conservative. So if that is the case, I would say that ELSS can be a first step to start investing in equity. If you're already invested in equity, you understand what are the pros and cons of investing in an equity fund. You can look at this. So in terms of potential, ELSS is far, far better if you can withstand some amount of volatility there. Although I must mention that the capital gain beyond 1 lakh after 3 years is taxable. But then if you kind of, plan your redemption well, you can actually avoid paying any tax. So, purely on terms of return, purely in terms of the fact that it can be aligned to a long-term goal, my preference would be ELSS. But obviously, each individual have to look at their own risk profile and then make a decision.
Okay, so I think we set the stage now for this tax special on the Money Show. So let's get on with the other agenda that we have, and that is to answer yours, the viewer queries. The first query I'm going to take in is coming to me from by email from our viewer, Kirit Kapadia. Kirit writes in, I'm a senior citizen having the following breakup of interest income. Saving bank interest at 12,000 rupees, bank deposit interest at 22,000 rupees, senior Citizen Savings Scheme 2004, interest at 13,500 rupees. Interest on company FD NCD is 3,50,000 rupees. Can I get a full benefit of 50,000 rupees under Section 80 TTB or 47,500 for the balance? You know, Hemant, we sent you the breakup and what Kirit has shared with us by email. We forwarded that to you earlier before the show. How best can this viewer, our senior citizen viewer, be the most tax efficient? What would be the best way?
Well, I think in this case, clearly, since it's mentioned about exemption under Section 80TB, which is basically meant for senior citizen, which he is, but let's be very clear on what all is covered in this. There's an exemption limit of 50,000 there. So what it covers is basically the interest that you get from saving bank account, bank deposit, and a cooperative bank deposit, and post office schemes. It does not cover company deposit or senior citizen scheme. So all those options which are beyond three, which I mentioned, saving bank account, bank deposit, cooperative bank deposit, and post office schemes. Others cannot be claimed in this. So this 50,000 limit is basically applicable to only these 3 or 4 investments. All other investments will be taxed as per their applicable rates.
Okay. Kirit Kapadia, senior citizen viewer, I hope that helps you out. In case it doesn't, don't worry, you can always write back to us and we'll take your follow-up query as well. I'm going to move on to the next query that we have again by email. It's coming from Ganesh Yadav. Now, Ganesh Yadav is 48 years old. He watches ET now and writes, I have the following SIPs. They're going to come up on the screen for all of you that are tuning in. I have already shared this portfolio with Hemant before the start of the show. So the portfolio is what you're seeing of our viewer who's 48 years old. The query that Ganesh has sent us is as follows. This is for my retirement corpus. I can take moderate risk and my expectation is a return of around 12% CAGR. Please comment on my portfolio. Hemant, we've shared the portfolio with you. It's on our screens as well. Hemant says that he's conservative, is happy with a 12% CAGR return, wants to build it up for the retirement. What is your advice?
Well, I think there's a slight contradiction in what he's saying. He's saying that he's a conservative investor. At the same time, he's expecting return of 12%. Obviously, there's no conservative option that can give you that kind of return. And I'm assuming that he's talking about post-tax return. So clearly, he needs to really rethink on his own risk profile. My view is that when you're investing for retirement planning, because it's a long-term goal, in his case, maybe he doesn't have that much period to build that corpus. So you still have option of looking at equity fund and maybe a mix of hybrid funds. Because your expectation of 12%, obviously, like I said earlier, cannot come from a conservative option. So definitely mutual fund is a good bet. You need to make sure that your asset allocation is appropriate so that it can generate that 12% kind of return, and that can happen either from pure equity fund or it can happen from equity oriented hybrid fund. So I think these are two categories of fund that he should be looking at.
Let me put it this way to you. What then is a conservative return? Would it be just meeting the FD return?
Well, I think the point is that, as I mentioned earlier, when you're talking about building a corpus, the biggest challenge for retirement corpus building is that you need to get a real rate of return which has to be positive. And when you talk about conservative like FDs, the point is that the returns are low. At the same time, you have to pay tax on that, which clearly means if you're in the highest tax bracket of 30%, even if you make 7%, you're paying 2.10 as tax on. What is left for you is 4.9. The long-term inflation rate in India is around 6 to 7%. So clearly, even though your money will be growing in number, but it may not be actually growing in value. So clearly, we need to understand that when we talk about investing, we generally focus on a risk of not losing capital, which of course is important. I'm not saying that it's not important, but at the same time, there's another risk of inflation, which to me I think is a far bigger risk. So anyone who's investing for a goal like retirement planning should be keeping that in mind. And when you invest for a longer period, and through systematically in equity funds or balance funds, like I mentioned earlier, a lot of risk that comes with the volatility is taken care of because you benefit from averaging.
Okay, so that's what for all of you that don't like taking risks, that's what a conservative return is all about. With that, we're going to take a short commercial break. Hemant, stay with us. We're taking this commercial break, coming back and talking more on the Money Show about taxes and mutual funds too. Welcome back. You're watching The Money Show here on ET Now. I'm Nayantara Rai. All of you might know this, but there's some of you who don't. The Times Network and the Association of Mutual Funds in India, that's AMFI, recently launched an initiative called Jan Nivesh. It's an investor education initiative that's getting people to pledge just 1 day's income. That's right, just 1 day's income into mutual funds. This will, of course, have long-term benefits. So what are you waiting for? All of you can also be a partner in this journey of the growing Indian economy, and all you have to do is give a missed call on the number that's on your screens. That's the number, the free, toll-free 1-800 number. And with that, you pledge to invest just 1 day's income into your future via mutual funds. Our expert today on The Money Show is Hemant Rustagi. We've been talking primarily tax with him. It is Wednesday, so we dedicate The Money Show to tax, all your tax problems. I believe we have a live caller, Milan, joining in from New Delhi. I just want to inform all of you watching right now that you can also dial in live and get Hemant to answer your queries. Milan, good evening. Welcome to The Money Show. How can we help you?
Hello. So I have just turned 25 right now, and my savings per month are in the range of 80K to 1 lakh, and I am looking for an investment for 10 years and average rate of return in between 12 to 15%. So how should I design my portfolio?
Well, in your case, because you're looking at, and you're new to mutual funds, you're new to investment maybe, and your time horizon is around 10 years. Since the objective is to build a corpus, so my recommendation would be that since you're also looking at investing every month, you should be taking SIP route, which is basically, which clearly means that you commit to invest a fixed sum every month in a predetermined fund. So it's important here for you to choose the right asset class for your given time horizon that you have. I think you should be looking at good quality, well-diversified equity funds. Because I only have this information that you want to invest this sum, so I'm basically focusing on that. So when I talk about equity funds, very, very important that you need to become comfortable with this asset class, which happens over a period of time. So my advice would be, don't make your portfolio very aggressive by straight away looking at some sector fund or thematic fund. Look at well-diversified multi-cap fund. Couple of funds, if you want, I can kind of recommend to you. You can look at Kotak Standard multi-cap. You can look at Mirai Asset India Equity Fund. These are two funds which basically invest primarily in large cap and some in mid cap. And you can look at one or two mid and small cap fund. In the small cap, you can look at HDFC Small Cap Fund. And in the mid cap, you can look at Axis Mid Cap Fund. So these are 4 funds. If you start investing in, you will see that you have allocation to different segments of the market will be perfect. And the key factor, of course, would be that ignore the volatility on the way, continue your investment process, and as your income grows, if possible, keep increasing your SIP amount and avoid having too many funds in the portfolio.
Okay, I hope that helps you out, Milan. Keep calling us. You can do that. We bring the Money Show every weekday from 5:30 to 6. We get a new expert to our studios every day. So I'm sure if you have following queries, only 25. It's a long journey for you. You can partner us in that. Time now for the next caller. I believe our viewer Ramindra Reddy from Chennai is dialing in live. Thank you. How can we help you today on the Money Show?
Hello, good evening. Hello.
Yes, good evening. What's your query? We can hear you. What's your query? How can we help you?
Yeah, my query is that I'm working in the government sector, and I wish to invest approximately 25,000 per month in mutual funds. And the main purpose of the investment would be for my son's education. And I have also invested approximately 1,50,000 per annum in LIC policy, so that I get some returns after 17 years. So I still have additional 20 to 25,000 per month which I can spare. So can you please help me as to what is the right way to invest now?
Okay, could you give me some idea about what is the time horizon you're looking at? How old is your son? And when will this money be required?
Yeah, he's 10 months old, and I would be probably retiring after 17 odd years.
Okay, great. I think this is a perfect example of starting to invest early. I think this is a perfect age for you to start investing for his education. You have broadly, I can say, around 18 years till you require this money for higher education of your son. Clearly, with that kind of time horizon, and considering the fact that in education inflation in India is very high compared to a normal inflation, so you will require a large corpus. Although it's very difficult to decide at this stage what kind of education you would like to provide him, but we clearly understand that going forward, the cost of education is going to be very, very high. So always keep that factor in mind. Therefore, looking at the fact that you're looking to build a large corpus and you have a time horizon of 18 years, my recommendation would be again to go for all equity funds portfolio. Here again, it's very, very important that because equity itself is an aggressive asset class. So make sure that you are having a portfolio which gives you, appropriate exposure to all three segments of the market. I already mentioned about few funds. I can repeat that for you. Look at your core of the portfolio should be multi-cap fund. Look at Kotak Standard multi-cap. Look at Mirai India Equity Fund. And then because your time horizon is 18 years here, clearly you need to have some exposure to mid and small. So excess mid cap will be another fund that you can look at, or then in the small cap you can either look at HDFC small cap or L&T emerging business. So look at 3 or 4 funds. Don't have too many funds. Continue to invest, and since it is difficult to figure out or envisage how much money you will require for education, make sure that as the time progresses you keep increasing the investment amount for the education of your son, because that will really help you in building up a large corpus.
Okay, Ravinder Reddy, I hope that helps you out. Through you, we're also teaching other ET Now viewers the advantages of starting early and how they can start early. With that, we're completely out of time. Hemant, I'd like to thank you for always joining us here on The Money Show. It's always a pleasure having you. And folks, we'll be back tomorrow, same time.